Hi, and welcome to the Stock Market Palantir. Don't forget to subscribe and drop your comments below. All right, let's see the analysis.
Let's look at the tape, specifically the trading window of late February 2026. On February 23rd, Oncotelic Therapeutics, ticker OTLC, opened at 40 cents. It hit a daily high of 44 cents and closed right back at 40 cents. But here is the metric that actually matters, the one that screams for attention. The volume. We saw 1,146,361 shares change hands. That is a substantial spike over the 30-day average. Then, you turn the page to February 24th, and the price tightens to 41 cents on lower volume, roughly 670,000 shares. The tape is trying to tell us something.
Hold on. We have to pause right there because those numbers, while technically on the tape, they mask the absolute reality of the liquidity situation. You're quoting the adjusted close, but if you look at the verified real-time bid and ask data as of February 20th, the stock was actually trading at approximately 4.5 cents. 0.0465 to be precise.
Right, the spread.
Exactly. That massive discrepancy between the reported adjusted closed 40 cents and the transactional reality of 4 cents is exactly why we are here. It's not just volatility, it's pricing confusion caused by an incredibly thin market. You can't just gloss over a 10x price spread.
I think that confusion actually strengthens the case for what I'm seeing as a massive dislocation. The central tension here is undeniable. On one side, we have a company with a market capitalization hovering around $20 million. On the other side, we have implied asset value suggesting this company should be worth hundreds of millions. Is Oncotelic a valuation arbitrage waiting to snap back to reality? Or are we looking at a distressed microcap spiraling the drain?
Well, I think the framing of distressed is putting it lightly. I'm looking at a liquidity trap. You see a $765 million theoretical asset. I see a company with a current ratio of 0.08 that is struggling to keep the lights on. That isn't a dislocation, that is a warning siren.
And I'm arguing that the market is completely ignoring the fundamental value of the pipeline and the $1.7 billion joint venture valuation. I'm representing the bull case today. The math simply does not add up at these price levels, and the market efficiency has broken down.
And I am here to represent the bear case. That financial health metric, specifically the Piotrowski F-score, and the complete lack of institutional support point to a value trap driven by necessary but incredibly painful dilution. You're looking at the ceiling, I'm looking at the floor falling out.
Let's get into the core of my position then, because the math is the strongest advocate here. Currently, the market capitalization of Oncotelic fluctuates between roughly $19.9 million and $20.6 million. In the world of biotech, that valuation is usually reserved for shell companies, reverse merger candidates, or, failed science. But Oncotelic isn't a shell. It has active trials.
It's certainly not a shell, I'll grant you that. But the market cap reflects the cash, or lack thereof. The market isn't pricing the science, it's pricing the bankruptcy risk.
But look at the independent valuation. We have a third-party analysis from Frost & Sullivan regarding the GMP Bio joint venture. This isn't back of the napkin math from a Reddit board. Frost & Sullivan valued the total pipeline at $1.7 billion.
Sure, on paper.
Let me finish the math. Oncotelic holds a 45% stake in that venture. Simple arithmetic gives us an implied value of $765 million for Oncotelic share alone. If you run that against the share count, you get a pro forma net asset value of approximately $1.73 per share. We are trading at pennies. Literal pennies. Yet the asset value is over $1.70. The company is at a critical juncture, transitioning from platform build-out to late-stage execution, and the market is pricing it as if it's going out of business tomorrow.
I'm sorry, but I just don't buy that implied value argument. You cannot pay the electric bill with implied value from a Hong Kong consultancy report. If we look at the actual financial health, the picture is stark. I look at the Piotrowski F-score. For those listening who might not track this daily, the Piotrowski score is a 9-point scale used to determine the financial strength of a firm. It looks at profitability, leverage, and operating efficiency. Oncotelic scores a 2 out of 9, That is objectively weak. It implies deteriorating fundamentals across the board. It means margins are slipping, leverage is rising, and efficiency is dropping.
Scores like the Piotrowski are backward-looking, though. They take historical financial statements and project the past onto the future. They don't capture the pivot or the latent value of clinical data.
The current ratio captures the now. A healthy company should generally have a ratio above 1.0, meaning its current assets, cash, receivables cover its current liabilities or bills due within a year. Oncotelic is sitting at 0.08. That is significantly below the threshold. To put that in perspective for everyone listening, for every dollar of bills they have coming due in the next 12 months, they have 8 cents in liquid assets. That suggests a company is entirely dependent on external financing agreements just to survive the next quarter. And the market knows this. That's why the stock is down 40.69% year to date and down over 42% in just the last month. The market isn't ignoring the value. It's pricing in the risk that the equity gets wiped out before that value can be unlocked.
I agree the chart looks rough, and I'm not denying the cash crunch. But that brings us to the first major point of contention. Who is actually buying this stock? I argue that the massive buyers we are seeing are a signal of confidence. Look at Mast Hill Fund, LP. On January 23, 2026, they entered a securities purchase agreement. They took a convertible note with a conversion price of 7 cents. At the time, that was a premium to the market price. Why would a fund agree to a conversion price higher than the market rate if they didn't see an upside? That's a bet on appreciation.
That's a compelling argument on the surface. But have you considered the structure of that deal? You call Mast Hill a buyer, as if they are a long-term investor like a pension fund holding for a decade. They aren't. They are a liquidity provider. That investment is a convertible promissory note with 10% interest. Essentially, Oncotelic is renting money at a high cost because traditional banks won't touch them.
It's bridge financing, absolutely. In the biotech world, you often have to build a bridge to get to the data readout. It's expensive, yes, but necessary.
The mechanism includes put notices via the equity purchase agreement. To explain that simply, this allows Oncotelic to essentially print shares and sell them to Mast Hill to raise cash on demand. Mast Hill isn't holding these for the dividend. They're underwriting the burn. This creates a cycle where Oncotelic punts shares, hands them to the fund, and the fund likely sells them into the market to recoup their capital. This creates constant downward pressure on the stock price. And speaking of buyers, look at the 13F filings. There are zero traditional institutional owners, no mutual funds, no ETFs, no pension funds. If the value was so obvious, where's BlackRock? Where's Vanguard?
They don't play in the microcap sandbox until the market cap rises, you know that. Institutional mandates often forbid them from buying stocks under a certain dollar amount or market cap. They physically cannot click the buy button until the stock hits a certain threshold. But you're ignoring the other significant buyer, the insiders. CEO Dr. Vuong Trio converted $3.3 million of debt into equity. That is a massive insider buy. He swapped the senior claim on assets, debt, which gets paid first in a bankruptcy, for equity, which is last in line. That signals conviction. He is voluntarily moving himself to the back of the line.
I come at it from a different way. That isn't new capital injection. That is balance sheet restructuring. Converting debt to equity cleans up the liabilities column, sure, but it doesn't put a single new dollar into the bank account to fund the clinical trials. It's accounting maneuverability, not a cash infusion. It looks good on paper, but it doesn't pay the lab technicians or the CROs running the trials.
I'm not convinced by that line of reasoning because it ignores the incentive structure. Look at the restricted stock agreement, the RSA. It ties the CEO's compensation specifically to a market cap target of $45 million. That is a 125% increase from where we are right now. If the stock doesn't perform, he doesn't get those shares. That is the definition of skin in the game. The leadership is betting their own financial future on the stock recovering. They aren't just salaried employees watching the ship sink, they are lashed to the mast.
Incentives are one thing, capability is another. The CEO can want the stock to go up, but if the dilution from the Mast Hill agreement floods the market with supply, the price will struggle to rise regardless of his intentions. Supply and demand apply to stock certificates just as much as they apply to anything else. If you flood the market with paper to pay the bills, the price goes down.
Let's pivot to what will actually drive that price up, regardless of the dilution. The science. We aren't just trading paper here, we are trading a pipeline. The crown jewel is OT101, the TGF-beta antisense therapy. It's in a phase 2b3 trial called STOP-PC for pancreatic cancer.
Pancreatic cancer is notoriously difficult. It's often called the graveyard of drug development. The survival rates are tragically low, and the biological barriers are immense.
Exactly, which is why the valuation upside is so high. If it works, let's get technical for a second so the listeners understand the stakes. TGF-beta is a protein that tumors use to essentially cloak themselves from the immune system. It creates an immunosuppressive environment around the tumor. If OT101 can tear down that cloak, because antisense technology literally blocks the production of that protein, it allows the immune system to recognize and attack the cancer. It changes the standard of care. The primary completion date is estimated for June 1st, 2026. That is just around the corner. We are months away from potentially validating a blockbuster drug.
I don't dispute the mechanism of action. TGF-beta is a validated target, but delivery has always been the problem.
And that's where the platform evolves. Look at the Decipical platform, specifically SAPU-003. They released new pharmacokinetic data showing a 67-fold reduction in gastrointestinal accumulation. Historically, these drugs accumulate in the gut and cause severe toxicity. A 67-fold reduction means the drug stays in the blood where it's supposed to work and doesn't poison the digestive system. That solves the toxicity issues that have plagued this entire drug class.
I acknowledge the science has potential. The 67-fold reduction is impressive data because it solves the safety profile issue. But my issue is the runway to get there. It's a race against time. Look at the Q3 2025 financials. They had $409,000 in cash. Their net loss for the quarter was $1 million.
They raised $628,000 in financing cash flow that quarter, though. They are managing the intake.
But look at the burn rate. R&D spending increased massively to $2.2 million. That is a 754,000% increase. Statistically huge because of the prior low base, sure. But in absolute terms, it means they are burning cash faster than ever to push these trials. You mentioned the June 2026 date for STOPCI. That is the binary event. But can they survive until June without diluting the equity holders into oblivion? And frankly, when I see them launching an AI platform, PDO AI, and an open access Discord channel, I worry about focus. Are these distractions from the core cash crisis? Why is a clinical biotech company running a Discord server?
I would frame it differently. The AI platform and the Discord channel are innovative validation tools. In an era where retail investors are smarter and more involved, Oncotelic is opening the books. They are using AI to mine over 125,000 PubMed abstracts to validate their TGF-beta targets. It's a low-cost way to show the world that their science is backed by the global body of research. It's not a distraction. It's a force multiplier for a small team. They are democratizing the due diligence process. And regarding the R&D spend, that increase is exactly what you want to see. It means the trials are active. If R&D was zero, the company would be a zombie. They are spending money because they are generating data.
They are spending money they barely have. That's the distinction. And this brings us back to the valuation. You rely heavily on this $1.7 billion JV figure.
Because it's the catalyst for the re-rating. The company is currently undergoing an ASC-compliant balance sheet remeasurement. ASC refers to the Accounting Standards Codification, essentially the rulebook for U.S. GAAP accounting. Right now, that $765 million value for their stake is theoretical. It's in a Frost & Sullivan report, not on the 10K filing with the SEC. Once that US-based valuation hits the books, the book value of the company skyrockets. Algorithmic traders, screeners, and value investors will see a stock trading at 4 cents with a book value of $1.73. That discrepancy cannot last. The accounting itself becomes the catalyst. The algorithms will flag it as a strong buy purely on the book-to-market ratio.
That's a compelling argument, but have you considered that the market often ignores book value when liquidity is the constraint? We see net stocks trading below cash all the time if they are burning money. Skeptics like me see that $765 million and apply a massive execution discount. We ask, great, you own 45% of $1 billion JV. Can you liquidate it today to pay the payroll? The answer is no. The value is locked up until an IPO of the JV or an exit. You can't write a check against the JV stake.
Which is planned for the Hong Kong exchange.
Planned, but not executed. Between now and that IPO, the company has to survive. The divergence between the theoretical value and the 4-cent reality isn't just ignorance, it's the price of risk. The market fears the dilution required to get to that IPO will mean that current shareholders own a much smaller slice of that pie by the time it's served. If you own 1% of the company today, but they have to double the share count to pay the bills, you only own 0.5% tomorrow.
That is the definition of arbitrage. You take the risk of the time gap to capture the spread. If there were no risk, it wouldn't be trading at 4 cents. It would be trading at $1. The upside potential here is asymmetric. Even if they dilute by 50% or even 100%, the gap between the current market cap and the asset value is so wide, nearly 40 times, that the trade still makes sense. You could cut the asset value in half and double the share count, and you're still looking at a 10x return from these levels.
That assumes the equity survives the debt structure. Let's not forget the debt-to-equity ratio is 2.22 times. That is high leverage for a clinical stage biotech. Usually you see this kind of leverage in utilities or telecom, not in a company with no revenue. If the STOPC data in June is anything less than stellar, that leverage becomes an anchor. The convertible notes held by MassTil have covenants and conversion rights. If the stock price drops, the conversion terms can often become more punitive to existing shareholders. It's what we call a death spiral. If the price drops, the lender gets more shares to cover the debt value, which they sell, dropping the price further, requiring even more shares. But the MassTil deal had a fixed conversion at 7 cents initially.
That shows a floor of sorts. They didn't structure it as a purely floating rate right out of the gate. And don't forget the expanded IP news from February 12, 2026. They are expanding into CNS and neurology, crossing the blood-brain barrier. They are building a portfolio that could attract a strategic acquirer before they even need to rely solely on the public markets. Big Pharma is always looking for assets that can cross the blood-brain barrier. It's the holy grail of neuro-oncology.
IP is valuable, I agree. But IP doesn't pay the monthly burn rate until it's licensed or sold. We are circling back to the same issue. You see the asset, I see the liability. You see a patent, I see a legal bill to maintain it.
And that is the crux of the debate. So let me summarize where I stand. I reject the label of distressed in the sense of a failed company. This is a company with validated assets, OT101 and SAPU003, and a very clear path to value realization in 2026. We have the STOPC readout in June, and we have the balance sheet remeasurement. I view the current price action, whether you call it 4 cents or 40 cents, as a massive mispricing opportunity for those with the patience to wait for the accounting and the clinical data to align. It's a classic deep value play in a sector that hates uncertainty.
And I remain cautious. I see a company in a very narrow liquidity window. The financial metrics, the current ratio of 0.08, the Piotrowski score of 2, scream high risk. The reliance on convertible debt through MassTil creates a structure where the financier wins regardless of the stock price, but the retail investor might not. The technology may very well work. I hope for the sake of the pancreatic cancer patients that it does, but the equity structure might wipe out the current shareholders before that value is realized. You can be right on the science and wrong on the stock if the company goes insolvent before the finish line.
It seems we agree on one thing. June 2026 is the date.
Absolutely. It is a binary event. There is no middle ground here.
The STOPC trial results will either validate the billion-dollar narrative I'm subscribing to, or they will confirm the liquidity fears you've outlined.
It's the moment of truth. Until then, it's a high-wire act without a net.
Indeed. And for our listeners, that is the question you have to answer. Is the valuation arbitrage worth the execution risk?
Or is the liquidity trap too deep to escape?
We'll find out in June.
If you like this video and want to watch more content like this, don't forget to subscribe. Thanks for watching. See you.